membership, business owners to actually share their lessons learned from the previous crisis that we had, the financial crisis of 2008. So we thought that that was very valuable information to share. And just the main point that I'm sharing all this with you all is that the Minority Business Alliance is really, our goal is to relentlessly provide value to you as a member. So lastly, in June, what we did is brought in several individuals representing the city, the city manager, Dr. Teron Richardson, the director of economic development in the county, Roger Johnson, and Elizabeth Cromwell from the Chamber of Commerce to share with our group on what's going on, what has happened since February up until June, and to really share on what resources are out there now. So here we are now with this thought process around these financial conversations, the importance of access to capital for minority businesses, grant making happening, increasing, and we're greatly in appreciation of that. But we know and realize that there's a next level of understanding. Grants are game changers for small businesses because you don't have to pay them back. And it's been a blessing. I've been blessed with a grant before, and it's definitely a game changer. However, it's a very important component of businesses is understanding finances because grant money is not always available. And so we need to be prepared to get ourselves for the next level, for that on-ramp towards this larger conversation of financial access and how do we attract money from banks or investors? What does that look like? What do we need to be thinking about in our business? So that's why I'm so very excited about this particular session and this particular series, because myself personally, I had to file bankruptcy back in 2009 because of my business. Had a thriving business, tons of cash came through my business. However, I still wasn't prepared for the financial crisis and I had to file bankruptcy. So it's important to me personally, and I think it's important to you all, not to preach, but to just want to share with everyone this value that we have. So very excited for our guest. Today, we're going to provide a 30-minute session for our illustrious guests to share information about financial statements and strategy. We've been concentrating and talking about tactical things for the past few months. And when I mean tactical, I mean talking about operations and how to sustain operations, how to survive on a day-to-day basis. Now it's time for us to back up and start thinking about strategy, because tactics actually implement strategy. So now it's time for us to talk about strategy and how numbers and how finances can guide your strategy on how you sustain your business, but also prepare to grow and thrive. So without further ado, after our 30-minute session with our guests, then we'll leave 20 to 30 minutes, however much time we have, for engaging conversation, discussion, Q&A, and we beckon all of you all to please plug in, ask questions. The dumbest question is the question that's not asked. So without further ado, for the last time I'll say that, I want to introduce you all to David Deaton of the Deaton Group. He's an excellent gentleman in this community, and his business is all based around business consulting and helping businesses to look at it differently, helping them to grow. And now, everybody give a small virtual clap for David Deaton.
Oh my gosh, what a warm reception. First of all, Quentin, thank you for that wonderful introduction. Thank you for the Minority Business Alliance to give me the opportunity to be with you. But most importantly, thanks to all of you for taking some time to talk about this topic that I equally share in Quentin's words about how important it is, but just the passion behind it on how we can think about our businesses to be more successful. I saw that Andrea already put into the chat box about asking questions. I encourage those as well. Quentin or Andrea, you're welcome to interrupt me at any time to make sure those questions get asked. I also look forward to the end of this when we can have a good dialogue as well. So thank you very much for the opportunity to be here. And I hope I rise to the occasion of the wonderful introduction. I'm so glad that there are many friends out there that we were talking about just in the first few minutes before we even started that I know are on here, because it gives me a great warm reception that as we have that dialogue, I'm sharing this conversation much like we might share around a dinner table and have those kind of peer conversations. And I welcome all that interaction and the warmth that comes from being able to discuss with peers in that capacity. So the purpose of this discussion and to share some of the content that I want to provide over the next 20, 30 minutes is really to stimulate that discussion. And in stimulating that discussion, does it sort of build confidence because we're talking about numbers in a way that is intuitive, and we're becoming more familiar with the vernacular and more familiar with the numbers and how we can talk about them. So I'm hoping that that builds confidence because we're just having that open dialogue and we're having a stimulating discussion. To have that discussion, I thought it'd be good to have 3 provocative statements that I could throw out there and then discuss. Now, those provocative statements are meant to sort of spur conversation and maybe shift perspectives ever so slightly. As the intro or the title of this is about taking charge of that narrative, part of it is putting those statements out there to get a shift in perspective in order to figure out ways in which we can change that narrative. And then the second part, which again, I've said earlier, I look forward to that open dialogue. Part about putting out a provocative statement, and this goes into the very first ground rule that I want to do before even sharing them, is that they are just that. They're not perfect truths either. And so by stimulating that discussion and shifting that perspective, it invites opportunities to understand when they're not true. And that's important because when that happens, we see opportunities and avenues and ways to have financial success. So I'm going to throw out some statements, and then I welcome not the critique of, hey, that's wrong, but more the dialogue of when is that wrong? Because that's when it opens up opportunities to understand financial success. The second ground rule is that I'm a business analyst and a small business owner just like you. I consider this a roundtable discussion. I'm not an investor nor an accountant, but with you, shoulder to shoulder, I have these discussions with small businesses, and I have these discussions with myself about my own business all the time. And so this is very much a roundtable discussion with you about things that I think about and things I want to be able to share. The third bullet point is perhaps important in the ground rule is that we can talk about numbers without it being boring. And part of, I think, the reason why numbers in general, and certainly financial numbers, are intimidating or things that we don't like to always talk about is because I always think of, if this box, fill in these numbers in this box, and then these 2 boxes add together, and if they're greater than this, due to this. And I feel like that's how we think about the numbers. What we need to think about is what are the underlying concepts of why they're working together the way they should? What are they trying to tell us about our business performance? And if we know that, then we really want to see those numbers to tell us the story that we've been trying to do, whether it be strategically or operationally. And so I want to be able to have a conversation around finance without there being boring numbers involved, because really that's what gets us excited about understanding the numbers that we eventually want to be able to see. So with those ground rules, I'll have the three statements, and then I want to go into each one of them. The first statement is around access to capital. Not all startups and businesses can get funding. I think it's just a truth that maybe doesn't always get acknowledged, that when we look at the criteria of businesses, not all of them can. The second is that we have to understand what investors care about, which is, and I'm being provocative in some ways, they care about scaling and selling their exit. And we'll go into that. And then the third is that your income statement, which we spend a lot of time on, is not really the focus, or it's not the main financial focus of what your business is all about. And so if you're looking at your operating income, you're looking at your income statement, you're missing opportunities to think about the other financial statements that may have more strategic value to understanding what your business is all about. So these are my 3 provocative statements to slightly shift perspective, but also point out some areas, in fact, when they're not true as well. So let's dive into the first one. Not all startups and businesses can get funding. Yeah, I have to be honest, I hear this a lot. When talking with small businesses, that I want to be able to get capital. I want to be able to find an investor. And sometimes that may or may not be true based on the criteria of which that business is running. So this is a pretty messy slide, and I apologize for that. I wish I had more opportunity to clean it up. But in the center, which I'm going to start talking about, is the landscape of Charlottesville, and then surrounding all of it are potential sources of capital that might be available for any one of these businesses. But let me first talk about what we believe we understand about the makeup of the businesses within Charlottesville. So there's about 8,000 establishments. That includes nonprofits, government, and businesses as well. And there's not a lot of perfect visibility into this information. I always go to InfoUSA as an initial source, and there's errors and challenges with how they report data as well. But let's just take, for instance, as there's 8,000 different establishments. And starting at noon and then moving around, there's about 1,200 franchises in the area, maybe a little bit less, branches or franchises. There's probably, and I think this is being generous, there's probably about 1,000 already existing equity-backed businesses. These are businesses that may have venture capital, angel funding, or private equity investors. And then there's about 400 businesses that are, 400 establishments that are nonprofits. Then I took the rest of these and I separated them. So in purple, it shows that there's about 60% of businesses that are independent, that are not equity backed, and they have less than 10 employees. And then at the very top are those businesses that have more than 10 employees. So understanding this diagram for me, and then referencing it back to the sources of capital, one source of capital for franchises is their corporate parent. So a lot of corporate parents may buy the property and then the operator leases it back, or they may buy the equipment and the operator leases it back. So that's a way in which they're getting funding because they've got a corporate parent behind them. If you're an investor, you're looking at interest, and I mentioned earlier, and we're going to dive into it more, but you're thinking about businesses that have a particular type of scalable profile and they can have an exit. Same with the entrepreneurial contests. And then with a lot of government funding, especially prior to COVID, is either around that discovery and innovation, like SBIR grants that might be coming from the Fed, or economic development that might be looking at job growth or traded sectors, businesses that can sell goods and services outside the state. And usually there's probably a certain size that may come with that as they move forward. So those are on one side. Businesses in the purple, more often, their sources of capital are banks, which are looking for collateral. Their friends and family, which may have money, but may have actual collateral that could be used on their behalf when that business is working with the banks, or profit sharing. And so if we're in that 62% of those businesses that are, and again, these are just estimates for discussion. Someone could argue with me that it's really closer to 40%, or maybe it's 70%. I don't want to get caught up with the precision of it, but I think there's a big chunk of businesses that are independent and non-equity backed and are less than 10 employees. And their accesses to capital are going to be more challenging than other types of businesses that are out there. And so we look on that left-hand side, banks, friends and family, and creative opportunities with profit sharing are probably going to be some go-to sources. And with banks, they're a strong partner in that success. They're oftentimes looking for collateral or ways through friends and family you can get collateral. Because that does mean that there's going to be portions of businesses that don't have access to funding. Now, I've got that little prayer symbol at the very bottom because we are so blessed and fortunate within the Charlottesville community to have the CIC, the Community Investment Collaborative. I think they do wonderful work, and I speak and volunteer there because I believe in what they're doing. But they do make access of people that complete their program. They make access to microloans, and they do wonderful work. During this time period, there's been a lot of resiliency grants. There's been a lot of COVID-related grants. The MBA's done grants. These are incredible new access that wasn't there before, that is absolutely tremendous to stimulate and be engaged with businesses that are in the area. So there's absolutely a lot of different exceptions, especially right now, that are present, that every business should be thinking how they can get in front of and have access to. But under normal times, we have to remember that not all businesses will have access to funding that they may want. Now, the one that gets the most attention is around investors, getting an investor to provide capital. So I want to sort of carve one of those out and talk about what an investor might be thinking about, because a lot of businesses that I speak with want to be able to invite outside capital, outside of the owners that have contributed. They want to invite outside capital in order to get equity into that business. And there are, in my perspective, 3 questions that an investor cares about. Do you have defendable margins, which is translating into cash of that business? But do you have defendable margins? So in the face of growing and getting bigger, can you face competition and still grow and advance your profitability of your business? A lot of businesses are doing well now, but as they grow, they may introduce competition and they're not defendable margins. The second is this business scalable? Are we thinking about the Mid-Atlantic region? Are we thinking about the East Coast? Are we thinking about the nation? We want to think about scalability of that business. And then the third, and there's some cracks in this one, but the third is there a viable exit? So if I'm, I used to have a mentor of mine that said, there's never a buying stock. It's only selling stock. The question is whether you're going to sell it now, which is short selling, or whether you're going to sell it in the future, which means you buy it now and sell it in the future. And it's the same with businesses. If you're investing in a business, you're trying to figure out when you're going to have your viable exit. So when you're talking and working with an investor in order to potentially invite their equity into your business, you've got to also be able to present to them how they're going to get their money out. When is going to be, are you going to grow to the point where the Home Depot is going to take over and buy that business? And that's that viable exit. Or there's 3 other people, you're going to get the scale, and then you're going to merge together, and then somebody else is going to take them over. That's the type of thing that they're thinking about. It's also, if you're a founder of that business, and it's either based on your unique skill or it's part of your personal passion to be successful, you may represent a barrier for that exit. Because in order for that business to be sold, you may have to leave it. So when wanting to invite outside capital, having those defendable margins in the face of competition, having a big scope, and recognizing that there is a viable exit, these are the things that our investors are thinking about. This is why they're gravitating to areas of discovery and innovation, because it lends itself for getting an idea done, showing how it could be transformative within a particular marketplace, and then scaling it up. I was talking with a venture capitalist that's based here in Charlottesville, although they didn't do a lot of investments here. And they said, I want to learn about businesses that can go from 10 employees to over 100 employees in less than 18 months. And that's just the type of scale. Now, again, I've got that prayer symbol because there's some actors out there that defy some of these sort of provocative, if you will, statement and these criteria. If you've got a person who's part of patient capital or an impact investor or a catalytic investor or a social entrepreneur or social investor, they're maybe looking a little bit differently about the landscape of the investments that they're participating into, but they're rare. They're hard to find. And when you do find, then you want to be able to cultivate that and have that conversation with them. There's not always a lot of them. A question came up from Sarah. Can I define equity and non-equity in this context? So I invite other opinions of this, either off mute or afterwards. But the way I'm thinking about it with equity is financial equity, not necessarily sweat equity, if you will. So people that are willing to say, I'm going to give, $5 or $5,000 or $50,000. Like, these are equity partners that are coming in and giving outside capital in order for that business to be successful, and not necessarily talking about outside, the inside, either a partner or through someone who's delivering sweat equity as far as the overall operations of the business. Thanks, Sarah, for that question. Now, before I get to the third provocative statement, I want to kind of set it up by talking about financial statements, the 3 financial statements, and looking at some of the numbers of the business. So I want to set the third one up a little bit more and provide some information. The first is that in every business, there are 3 statements: the statement of cash flow, the income statement, and the balance sheet. And I think what's amazing about the business community is that these statements exist. There's not an infinite, well, there are in some ways from an analytical perspective, but there aren't just an infinite number of things that are out there in order to describe a business. Over time, we've gravitated to 3 things. And if we understand these 3 things and we make them accurate to that business, we really can understand what's happening by understanding just 3 reports. Most of the time when you get these reports, they're 1 page each. That's all the numbers that we need to look at in order to understand what's going on in this business. And we put everything in it. We track everything and we report everything that's pertinent to that business. And that really helps us understand what's happening. And so sometimes when I'm working with business, the first thing we do is we say, hey, I'm not asking for access to QuickBooks, but can we get these 3 reports? We really need to understand what's going on. And so I want to share with you a bit, for those that are less familiar, I want to share a little bit about what each of them is trying to say and why they're different and how they work together. The first is that income statement. So that is looking at the health of the operations. So you've got revenue, you've got expenses, and you either have some sort of profit or some sort of loss. So that income statement, I noticed that there's one nonprofit in here. It's often sometimes called a statement of activity in the nonprofit sector, but it's the same concept. The key feature with the income statement that really connects it to the others actually is that the income statement is time bound. Tell me what's happening that month. Tell me what's happening that quarter. Tell me what's happening that year. What's happened over a period of time. It is a time bound report into the operations of the business. And we'll return to that in just a second. The other is the statement of cash flow, which is a little bit easier. Because if you've ever looked at your bank statement and you've seen all the cash going in and out, that's kind of like a statement of cash flow. It's the change of money in cash from operations, but it also allows to introduce change in money if you've been investing that money, or if you've got financing that might be taking place. So it's scoping in a little bit more than just the actual operations of the business. It's also bringing in other types of activities that affect your cash flow. And then the third is the balance sheet. And if you've ever thought about, or if you own a home, you understand a balance sheet. And that is, you have an asset like a home, you're carrying a lot of debt because of that home, and whatever is left between the debt that you owe back to the bank and the value for which you bought that home for is your homeowner equity, right? That's what you own as equity. A business is no different. They've got a collection of assets, and they've got certain debts against those assets, and then they've got equity for them. And the important feature and why it's called a balance sheet is because it has to balance. The assets have to equal liabilities versus the equity and the equity. But the key here to me, and why this is important to bring up in this context, is that the balance sheet is timeless. It's the sum total of all the value that you've been able to accumulate from your operations. So if the income statement is telling me something that's time bound, The balance sheet is telling me something that's timeless. It's the total sum value. And so why I said earlier that the income statement is not the point of the business is because if I'm looking at understanding where is the strategic value that has been invested in this business over time, I'm directing my attention towards the balance sheet. So when I look at the balance sheet of a business, I'm getting a perspective of how well they've been making strategic decisions to make their organization stronger. Income statement feels like a little bit of a rat race. We're in that wheel, we're in that hamster wheel. But what spins out of it that's so valuable, I gotta be able to make sure I'm putting into the balance sheet. So I use this image here to think about the balance sheet, because when times are good, we wanna be filling up that dam behind the wall, behind the dam wall. We wanna be filling it up with water and building a balance sheet. And when times are not so good, we wanna be able to open the spigot a little bit and get some cash from what might be in the balance sheet. We can get cash from operations.
May be like kind of ridiculous.
Sorry. We can get cash from the operations by trimming out costs, being more efficient, growing revenues and all that. But we can get a lot of cash also from the balance sheet of wealth. We've been storing it in there. And this is what makes the financial part of it so valuable, and understanding the numbers is because we want to be able to understand when should I constantly be making investments into my organization that's going to have long-term strategic value. When am I actually appropriately filling my dam, and how do I know how to let cash out without totally breaking this business? And that's part of that value. And that relationship between income statement and balance sheet is hugely important. Now, when we think about assets of an organization, we oftentimes think about, I've got cash, or I've got a building, or I've got property. But I would also invite the discussion around other strategic assets that you could be investing in when times are good. So when we think about building strategic assets, we think about how do we take what's wonderful about the people and are so special in our business, and how do we translate that into our culture? How do I take the individual relationships that I have and make them part of our business relationships? How do I take my experience and put it into systems and processes and policies? As I've joked, and other people have heard me say in different contexts, H&R Block, started out as a really good tax accountant out of, Kansas. And they put that process and it became a computer system and software package. How do we take reputation and invest it in brand equity when times are good, right? We know that these are things that we can do. And we're, ending with a little bit of the punchline later, these are things that now are been separated from the individual founder and they've been transferred into the business. These are things that investors would like to buy. Now, when times aren't as great, we think about maximizing cash flow. How can we optimize our operations, add revenue, control costs? How can we find cash in the balance sheet, payables, accounts receivables, inventory, anything else we've got? And then we're constantly analyzing what's our break even, what's our contribution margin, what are key ratios that we need to look at. So let me give you and share with you a couple of those key metrics that I often look at when I'm thinking about a business and what each of them means. So especially right now, looking at burn rate. What is the weekly or daily amount of cash that's needed to keep this business open? And as somebody who's on the call gave to me, what's that day zero? And if day zero is 30 days from now, when I have no cash, how do I make it 45 days? How do I make it 50 days? How do I slow my burn rate spend down? And how do I get as much cash in order to fortify it? The second is break-even analysis. And under normal operations, and we can think about tweaking it, but under normal operations, at what point am I indifferent that this much revenue is going to pay for everything that I've got in order to make things happen? Another one that's really critical is contribution margin, especially important during challenging times to think about what you want to price your services at. You have certain costs you can't avoid. You have other costs that only are introduced when you do something. And so those contribution margin is looking at how much money am I clearing for those costs that are directly related to providing that service. So I basically ignore, which sounds scary, I ignore all those costs that I can't avoid. And I just focus on what is that variable element and how much more money that I'm making. And the idea is, with the word contribution, how much money am I making that is contributing towards those costs I can't avoid? And positive contribution, yeah, variable cost, yeah. Positive contribution is adding value to the business because it's adding money that you can contribute back to the costs that you can't avoid. Now, there's ratios to the nth of time and there's additional analysis, but the ones that we hear about often are quick ratio, working capital ratio, and debt to equity ratio. And what's interesting about all three of those key ratios is that they're anchoring us back to the balance sheet. Hey, how much money do you have to take care of liabilities? Whether that be in the quick sense or in a working capital ratio. What's your debt to equity ratio? How much debt do you own versus how much owner value do you have? They're immediately taking us back to the balance sheet because I, as a person who works in strategy, I understand that strategy is stored in the balance sheet, but so is the financial performance. It all links back together. That strategy and finance link happens when we start to think about that organizational health. And what's really interesting and why I think that this is hopefully spurring thought or shifting perspective, or at least for me in many ways, is that if we start changing the narrative and we start thinking about what is my strategic link, how am I adding to my balance sheet, I all of a sudden become attractive to investors. That whole shift that I showed between people to culture and individual relationships and processes, all of a sudden, those are things that are scalable. Those are things that can have an exit and no longer a resident with inside the founder. If I focus on making my balance sheet stronger and the bank comes to me and talks about quick ratios and working capital ratios, debt to equity ratios, I'm now more attractive for the bank as well. And if I'm doing all of this and creating access to markets and new job growth, I'm making myself available for government grants that might be about economic development. So when we start to invest in understanding our financial health and making decisions around all those things, all those other accesses to capital that we didn't think were available to us, all of a sudden start to become available to us. And that's when we really ultimately start to change the narrative on how we're taking control of our financial health. And so with that, I want to be able to just say thank you for your time. I want to be able to open up to as many questions as possible. There are so many experts on this call with me that I know if I don't have an answer, somebody else will. And if neither of us have an answer, we're going to research it and get back to you and we'll give you an answer. But I absolutely want to invite comments and I want to invite questions for all of us. Quentin?
Well, first of all, I want to say thank you. I'm hoping that people are loading up their questions now. This is not the time to be shy. Like I said earlier, the dumbest question is the question that's not asked. What resonated with me, David, in your presentation is I recall back when I owned Charlottesville Players. And one of my biggest mistakes, although it was I had relative success here in Charlottesville, but I was totally attached to the business. Like if I wasn't there, then the business couldn't thrive, because back then at that age and at that level of understanding, I didn't understand systems and putting systems into place, and not even thinking about an exit strategy. And I understand that most businesses, I'll say a lot of entrepreneurs go into a business and because they have a strong skill set in something, and yep. they can be very successful with that skill set, but you can still be attached to the business, and you end up owning your job.
Yes.
and, working in your business and not on your business, because it needs your skill set in order for it to continue to thrive. So I guess I'll steal the opportunity to ask a first question and get things going. I work with, currently I own a company called Heritage United Builders, and I work with contractors, and I try to provide, it's a brokerage service, but it's also, I provide administrative support to those small subcontractors so that they can concentrate on the skill set, and I can help take care of the financial components for their business. What, in your experience, has been like the biggest mistake or oversight that entrepreneurs are not doing in the course of their business, where a gentleman been in the business 40 years, but still doesn't have an exit strategy, may want to sell the business, but having problems doing so? I'm trying to throw you an alley-oop off the backboard on what are some of the things that an entrepreneur should be thinking about if they ever wanted to sell their business?
Yeah, no, that's great. So and it kind of goes back to your initial point about keeping things pretty close. And I'll invite, by the way, other comments or other answers in for other insights. But what I would say is that if you're starting that business because of your skill, and certainly that is unique, and that has to be played into to be successful. So I don't want to minimize that. But how do you take stock of what, if I'm doing 10 things, let's begin that process of understanding what's that one thing that I might be able to have somebody else do. And then the next year it's the second thing or the third thing. And so we slowly try to work on the things that we can ask other people to do and that we can train them on and we can get them up to speed on, or that we can put into processes so that we can start to then focus on, okay, these are what we want is a much smaller list of things that truly, truly, truly only I can do. And then that's the last little bit that we try to get somebody else to help us with. But at the start, and this is, I think, the challenge that a lot of solopreneurs or a lot of entrepreneurs face, is they don't start that process of just what's that one thing out of the 10 that I do that somebody else could. So that's the first. The other is it becomes completely, another challenge is it becomes completely overwhelming to think about, how am I going to make this a process? And if we just literally said on the back of a napkin, hey, every time I end a client engagement or every time I did something, I send, here's my checklist of things we do at the end. I send them a thank you note. I send them a survey. I send them this. All of a sudden, you just documenting down on the back of a napkin, all of a sudden that becomes, oh, let's just put that into a pretty document and let's share it with, now all of a sudden it's a job aid that I can share with people in my company about how we close engagements. And then all of a sudden we say, well, I don't need to make that a job aid. I've got this new client engagement CRM thing that I invested in, and it's got a post-engagement process. Well, I know the 3 things I'm going to do with every engagement. Now all of a sudden it's your unique system that you've put into a system and software that you bought. So it went from a napkin to a job aid to being something that's invested into your entire IT infrastructure. And it's just that the challenge that's happening is just not beginning the process, not thinking about that first step that somebody else can help you with, or not thinking about that process that you might just want to define and repeat. And I think that's the biggest challenge that a lot of people have.
Y'all want to race me to mom?
And the more that that's done, then the more that you're transferring what is in yourself, you're transferring it into the business. That transfer process is something we work on a lot, or a challenge that we face a lot. I want to transfer myself into my business. It's hard. So there's a question that came in on the chat. I'm going to read it, and then I will also invite other people. It says, how much time should be allocated towards creating our financial narrative? At what point should entrepreneurs hire someone to manage the finances? I know there's a couple of accountants on here that would say, do it right away. But what I will say is that, download something like QuickBooks right away. Like that is, if you don't have something like that in place, make sure you do that immediately, right? Download something like QuickBooks, make sure you're tracking everything. If I go out and buy a 95-cent thing of paper clips, I've bought it in a way that I could track it, and I'm not using cash, and I'm booking it and it's going into QuickBooks. You better believe it. There's no amount that's not small enough. It is true though. Oftentimes when I'm working with organizations and we ask them for their finances, they're not quite in a shape. They're in good enough shape that we can get some clues, but not good enough shape that we could make a confidence about what they should be making investments in. And we would encourage them to go see a bookkeeper to get that cleaned up. It's beyond my skill set. Oftentimes when I'm working, I know there could be others, so I'm not trying to plug. Bryce is somebody that I've worked with several times before. And I feel fortunate enough to know enough clues to say, hey, Bryce, these are the challenges that I see. Doesn't mean I know how to fix them. I needed that expert layer to go in and fix them. But I think it's fortunate for him to say, hey, these are some places to go looking because I'm already seeing that this may not look right or this may not look right. Not that they're doing things fraudulently, but they're just not organizing or categorizing things for success. So I think you're going to want to get to that level as well. How much time, and by the way, Donald, I see you, I'll let you in just 2 seconds. How much time you want to be able to do it depends on where you're starting at now. If you don't have great visibility into your finances, I would encourage you to take a moment and pause and get a little bit more visibility. If you've already got some visibility and you're wanting people to refine that and give you your statements, then I would encourage you to go that route. Again, it goes to that first point that I said, what can others do and what can you do? So others can help you with financial analysis and reporting. And I would, as soon as you are able to, I would invite other people to help you with that. So it's not consuming any of your bandwidth. It just goes back to that first point. Donald, I know you had a comment you wanted to add, please. I'll shut up so that you can do that.
Thanks, David. Well, hi, everybody. This is Don Gianangeli. I'm the Edward Jones financial advisor up in Hollymead. It's so good to see all y'all's faces again. It's been too long. But I just wanted to add that what I say to my business owner clients is once they've gotten to the point that David was just describing where the finances are kind of in order, it's a very beneficial thing to step back and look at the business as a tool, the biggest tool you've got in your toolbox to achieve your life's goals. We talked about, how do I get ready to sell the business, things like that. But there's also a point, if you are starting to achieve some success, where probably your tax person is going to tell you you're paying too much taxes based on the income that you're bringing in. And there are ways to reduce that reportable income through things like a small and really well-structured retirement plan for the employees that benefits the owner in a great way. And if you start to consider little pieces like that, which are easier than they look, what it might do is make it so that when you are ready to take bigger steps back from running the business and possibly bring in a partner or sell, you need less revenue to come back from that because you've done a lot to prepare for yourself and for your key employees. So I always tell my folks, focus on your family's needs and those financial objectives and make that part of how you think of the business.
Drone.
Great.
Of what this looked like.
And Allison kind of had my friend Allison kind of had a comment along those lines that she put in chat. You're welcome. Yeah, Allison, you want to color that in with some comments as well?
Yeah, it was just one of the, hi everyone, it's so good to see you. My name's Allison Linney. We just celebrated our 20th anniversary of Allison Partners, and I've been doing a lot of reflecting on the advice I was given in the early years. And one of the hardest ones for me to swallow was purchasing a long-term disability policy. And that my financial advisors wanted me to be able to pay for health insurance and that long-term policy long before I put any money away towards savings or retirement or anything else. Because statistically, it's very depressing. I am most likely to be disabled, not killed. Donald, I see you shaking your head. It's kind of depressing, right? And so that was one of those things. So now I have another long-term disability policy that's affiliated with my company and my employees' benefits. But if I were to ever go back to just me and not all of my employees, that policy goes away. Whereas the original policy sticks with me because it's not a group policy. And so that was just some tough love I was given early on, was to recognize that the thing that would be most debilitating to me, to my family, would be that I did not have traditional benefits as an entrepreneur.
Wonderful. Yeah, it's great advice.
Donald, is that what they still tell people? I see you're nodding your head.
Absolutely. The approach that I always take with my business owners is, let's define the goals first. And once we have those in place and we know we can achieve them, then the role shifts for the financial advisor to start trying to poke holes in the plan. Where could this go wrong? And you're right. The most likely scenario is that you lose the ability to do some of the things that are important for running your business. And that's where the term disability does come into play.
Yeah. I put in my ground rules that I'm not an accountant or an investor. I should have also put financial advisor. I'm a business analyst and a business owner. And these are the things that I think about. I think you've gotten some gems here from the comments that have been contributed.
So I have a request. I would like to hear from a new or an existing minority business, African-American business owner, to just get their insight, their feedback. What do they think about this information? Did it all glaze over? Does it feel like it's a waste of time? Any value? What's missing? What you thought you were going to hear? I'd love to hear from a few of you at this point. And also, you may have experiences that can go counter to or aligned with the information that has been shared. Don't be shy now.
Well, hey, I'll kick things off a little bit. My name's Freddie Jackson, and I'm the founder of the Love No Ego Foundation. And I think this is, it's been quite helpful. We're approaching 5 years, March 2021.
Congratulations.
And thank you. And, I think it's very helpful. I mean, in any point in any business, nonprofit organization, any type of structural organization, you're going to need that financial literacy. And I feel like, me personally, I can never learn enough of it, and pick up some things here and there. So I made a lot of notes. You guys said some great things. Defending margins, is it scalable? Some things I wrote down, the economic resilience, and among some other things. But yeah, I think it's great. And I think conversations like this should happen more often. So thank you guys for doing it.
Thank you, Freddie.
Hello, can you all hear me okay? Okay, my name is Tracy, and I just recently started working on healthy messages. And for me, this is really helpful because I'm just really a couple of months in, and I'm just grateful for just laying a good foundation. So for me, this is helpful to help lay a good foundation. So thank you.
Yeah, and congratulations.
Thank you.
Q, can I say one quick thing?
Sure.
I just want to let everyone know, I remember when I first heard these kinds of presentations 20 years ago, it was a little hard for me sometimes because I didn't imagine like who's going to invest and why was it going to have an exit strategy. And like some of the advice that I got was that there are many pathways to a successful business that do not involve investors or exit strategies. That's and right. So just if anybody's sitting there thinking, wait, what? Just know that I have no exit strategy. And I think a lot of you know me and know that I've had a reasonably, I mean, I ain't gonna lie to you, this is not gonna be the best year ever, but we're doing all right. Do you know what I mean? And Rachel and I say our exit strategies will stop when we want to stop doing this work. And people would say to me, early advisors would say, well, I mean, you have to have a way to sell the business. And no, you don't actually. Like if anybody feels overwhelmed or wants to chat about that, just know that there are plenty of good businesses that do not have exits that involve paying off investors or things like that. And so there are good ones that have it too, but people sometimes laugh to learn that I don't have an exit strategy other than I'll do this for as long as I want to, and then I'll stop.
Yeah.
Don't
Yeah, and I think that Allison, you raised a good point that not trying to portray one picture versus the other, because I think it's for me what it's about is aligning and when we're asking for outside investors versus when we're trying to build something that is wonderful and great and growing. So as we think about all those different paths, we want to align what we're trying to, the path we're going to with the request that we're making. And we may be able to find somebody who is saying, hey, look, we're going to do this for as long as possible. And maybe they're even an outside investor for as long as possible, but they're not interested themselves in that exit too. So I think all those different scenarios are incredibly true. And for me, it's about aligning up what I expect versus with the scenario that I'm going through.
And I will say thank you, Allison, for sharing that point, because that is not the ultimate and end goal for all businesses. Another example, you have businesses that you could start or you've been working in, and you could pass it on to your children, and
Sure.
it be a legacy business. So absolutely not the. I think it was an example was parsed out on.
Yep.
On this subject matter of seeking financing or just understanding finances as a whole. Like this foundation that we're sharing, this conversation that we're trying to cultivate in the Minority Business Alliance is centered around wealth building and people understanding and expanding their options. When we get into business, that there are ways that we can grow our business that sometimes we may bump into the wall on. This foundational information, financial statements, you can glaze over on it, but actually it is part of the secrets of the temple. And there are these stages and these cornerstones of information that we can build on, that we be in a place where we look back on 2020 is like, wow, just like Allison was saying, how she looked back on 20 years ago. We can look back 5 years from now and we're like, wow, I'm glad that I started exercising these things, and look where my business is now. Look what I can create. Look what value I can create for other people. So I know that is 102 now. First of all, I'd like for everyone to join together to give another virtual round of applause to David Deaton.
Thank you all.
We thank him so very much for his time. Thank you, Ms. Harrell and Clarence Green, for finally coming back on video and joining us in video. We appreciate it. And we really thank you guys for joining in. Before we go, we want to share a couple of announcements with you, because this is, like we said, this is just the first of a series. So with that, I'll first pass the baton to our good brother Alexander Erpy, and then he'll pass it on to Kay to give you guys some closing information.
Hi everyone, I'm Alex Erpy with Emergent Financial Services. I'm also the Vice Chair of Finance. We just have a quick announcement on our Minority Business Enterprise COVID Recovery Funding Opportunity, which is a long name of saying a grant that we have put together thanks to our friends at United Way. And I'm going to put a link to the application. It is 5 grants that are going to be offered. They're ranging between $8,750 and $10,000 grants, depending on membership in Minority Business Alliance. Membership is a requirement, or you will join as a condition of receiving the grant. The deadline for that grant is going to be Tuesday, September 15th at 12 noon. And I'm gonna go ahead and put in to the chat box a link to that grant, and there will be details and all eligibility on the application page, which will be in the link. And that's all I have. I'll go ahead and pass to Kay, who has some more information on a future series.
Hello, everyone. Good to see you. I'm glad that you came out today. I am going to just share the importance of your participation in part 2 of this conversation. Clearly, we got some great information today, and I'm grateful for David for sharing and for all of the commentary. The city of Charlottesville will be hosting its annual Minority Business Celebration Month beginning in September. As a part of that, and I posted that information in your chat box, we are in the lineup to again facilitate part 2 of this discussion on the 22nd of September at noon. I would encourage you to continue participating with us, as well as take a look at that link, or should I say, go to that website to find out additional details about other opportunities that could also be good for you. We are also, if you have any questions, you can certainly hit us up on email, but I look forward to seeing you guys again in September. I hope you would be well and safe.
And thank you, Kay. And I lost all my formatting, so sorry to flood the chat box with that information. I wanted to give you guys just a title. The title of the next meeting under the Creating a Financial Narrative will be Demystifying the Loan Process. So we have scheduled Dan Maskowitz from Blue Ridge Bank, who will talk about the actual, we're just taking away the misconceptions and the fear and all the other things that we don't know or understand why we get turned down for bank loans, and what they're looking for, and what's the language, what are the what's the communication that we need to learn and add to our tool belt, that we can go in confident when it's time to seek capital from a bank. So that's our next meeting. Thank you so very much. Thank you all for joining us. And if there's not any other items to discuss, we shall adjourn.
Thank you all so much.
All right.
Bye-bye.
Take care, be blessed, be safe. Thank you, David.